CEO and chairman of the Charteris Gold Fund, which was one of the best performing funds, not only in the precious metals sector, but in any sector last year. So it rose 125%. So please tell us, how did you do it?
Well, it was the best, not one of the best.
Oh, the best.
And it was 135.
Oh, was it? Okay, sorry.
Yeah. Basically, the reason it outperformed the other funds so much was because it's got a very high weighting in silver as opposed to gold. It's a precious metals fund. It can invest in gold or silver. And of all the 7 or 8 precious metals funds in the UK, our one's got the highest concentration of silver mines relative to gold mines, which we got about 70% silver mines, 30% gold mines.
And do you hold any bullion or just straight?
That's a chart of the gold volatility against silver volatility. And you can see how much more silver will go up in a bull market. It goes down more in a bear market. It's just more volatile. So we always say to any investors looking at the funds, if you want to invest in precious metals, you're much better off investing in silver because it will go up more. If you don't like precious metals, then you don't buy either silver or gold. There's no real argument for buying gold over silver if you're bullish of precious metals. Because if your view is right, you'll make a lot more money in silver than you will in gold, or in silver miners as opposed to gold miners.
And so you don't hold any bullion, just strictly mining companies?
Yeah, I mean, the fund, there's no leverage. It's a long-only fund. It doesn't employ any leverage at all. It invests in mining companies. In terms of what sort of mining companies, we don't buy the very big ones like Barrick or Goldcorp because they're all on declining gold production, and we don't buy the exploration shares. So we have most of the fund is in $500 million to $2.5 billion market cap.
And what's your largest holding at the moment in the fund?
Largest holding is Mag Silver, which is it's got a world-class silver deposit in Mexico. Fresnillo is the operator of the mine. Mag's got about a 45% carried interest, and that's our biggest holding.
And so what's your sort of philosophy and strategy for next year? I know you look a lot at the gold-silver ratio, and a big sort of follower and believer in that gold-silver ratio. Okay, well,
if you look at the chart there, you can see that during bull markets, as we said, silver goes up a lot more than gold, goes up down a lot more in bear markets. We think that this period we're in right now is eerily reminiscent of December 2015, when the whole commodity complex bottomed out. It's probably going to have, this sector is probably going to have 2 or 3 weeks of quite turbulent weather because it's dominated by US private investors. And this year, anybody who's bought mining stocks has probably lost a bit of money. So you're going to get some tax loss selling by American investors for the next 2 or 3 weeks. Now, that's exactly what happened in December 2015. So when we came in January 2016, the prices were at quite depressed levels. So our fund went up 200% in 4 months, but from a depressed base. So obviously, the lower they drive the prices down in the next few weeks, all it does, it makes it cheaper for people to buy in January. In terms of the rotational effect of commodities, when you get a big bull market in commodities across the board, it tends to be led by precious metals. Precious metals is the lead sector. So what you saw in 2016 was precious metals leading the way. They were the trailblazers, and then they went into a period of consolidation, which has lasted the end of 18 months. And in 2017, base metals took over the running, and you saw some big rises in copper and zinc and nickel. And a lot of talk here has been about copper and electric cars and all that sort of stuff. But we think the next stage of the game is the rotation will now switch back to precious metals, and precious metals will now lead the next wave upwards in commodity prices, and actually the base metals are probably going to take a bit of a back seat. And if that view is correct, silver is going to lead the way again. And silver's semi-industrial anyway, so if all these other base metals are going up, there's no way silver is going to get left behind. So we expect to see a rerun of 2016, but not quite as sharp and as condensed as the first 4 or 5 months of 2016. This time we expected it to be more drawn out, but bigger in duration in terms of time and bigger in amplitude in terms of price move up.
And are you basing this on looking at the charts? Where is your basis for this rally to return?
We look at a lot of cycles. Now here's a chart here. There's an almost perfect 7.3-year cycle in silver, 90-month cycle. So you want to look here? Can you see?
Oh yeah, I can see it right there.
Okay, all right, okay. So if you did nothing other than every 7.3 years buy silver, you've probably made money. You don't need to be. So that cycle bottomed December 2015. So if that cycle holds good, it's going into the up phase of its cycle for the next 2 or 3 years. But the biggest gains are normally seen in the middle of the cycle, the biggest move. If you follow something called Elliott wave theory, there's 5 up waves in a bull market, and wave 3, which we think we're about to go in, is the big bull market proper. So we don't think this cycle tops out for another 2 or 3 years. And if you look at the supply of silver, more silver is produced as a byproduct of lead and zinc mining than out of primary silver mines. And what happened in the contraction phase when the big base metal mining companies started closing down mines led by Anglo-American is a lot of the lead mines were closed down because lead is a bit of a dinosaur commodity. But by closing down lead mines, you take zinc out the market, which is why zinc's gone up so much. But you also take a lot of silver off the market as an unintended consequences of closing down unprofitable and unwanted lead mines.
And do you see continued reduction in production of the precious metals?
Yeah, I think there's quite a pertinent case that you've seen both peak gold and peak silver production in 2015. China, which is now the biggest gold producer in the world, 400 tons. That's down 10% year on year, which is a huge fall. And again, going back to why we don't invest in all the big major companies like Goldcorp and Barrick, is if you look at every single one of those big mining companies, they all have declining production profiles. And it's a major problem for them because it's not sure how they're going to replace the, how they're going to get to an upward production profile. You've got to go all the way down to Agnico Eagle before you find a big company with a rising production profile.
And now you don't look at exploration. You prefer to look at when they're somewhat in production, but do you not think sometimes in exploration you can get an even greater return than when a company's already in production?
Oh, sure. I mean, you could buy, say, 10 exploration companies and one of them strikes gold and you can make 10, 20, 30 times your money. But the other 9 you've got to write off. But the problem for us is that we're running a fund that's daily dealing and we have to buy relatively liquid assets that buy and sell the fund. Also, we prefer to buy cash flow producing mining companies. We don't like exploration companies because, I mean, there's enough volatility in this sector, unleveraged, that you don't have to go into the real small companies to find it. That's a slightly different area of expertise than what we possess. So it's not really our bag.
And what percentage of the fund is currently in silver?
70%. We haven't changed it at all since 2016.
And so you're probably one of the funds that have the highest holding of silver companies in the world that I can know of.
Oh yeah, absolutely, yeah. But not by accident, by design. We want a higher exposure in silver because we think the next phase in precious metals is another fairly big upward move. And if that's true, if that's the case, you're going to make a lot more money in silver than you will in gold.
And what was one of your best performing companies in the fund last year?
Mag Silver was one. We've had... It was widespread. I mean, all the silver stocks probably did better. Your average silver stock did better than your average gold stock. But I mean, across the board. And we've got a wide spread of them.
And what was one of the companies that did not perform very well?
I don't know. I mean, we tend not to lose. We have low patience with ones. If they don't do well, we tend to kick them out fairly quickly. So we don't tend when I first came into the stock, I used to be a stockbroker, and the first thing I was told when you went on the stock market is you run the profits and cut the losses. So we try and, do that. If we buy something, it starts going down and it's not working out, it tends to leave the portfolio fairly quickly.
So you don't hold and hope?
Not really, no. So we think there's one or two real. So if you were to say, move on a little bit, say, well, what could possibly drive the price of gold higher? We think there's several things coming together that are going to produce very powerful up move in gold. Now, I don't know if everyone was here when Nigel Farage was giving his presentation, but he went off piste a bit and started talking about a bullish outlook for the dollar. Well, I sort of agreed with everything he said apart from that. We think the outlook for the dollar is distinctly dodgy, to say the least. And one of the things going forward that we think will happen, which is a major event, is that the Chinese are just about to launch a oil futures in Shanghai based in renminbi, and it's going to be convertible into gold. So it means that Russia, Iran, any countries that want to sell oil can now sell oil in renminbi, or will be able to in a few weeks' time, and convert those proceeds if they want. They can keep it in renminbi, but they probably won't want to do that because renminbi is not a reserve currency. They can convert it straight into gold. Well, that has one or two. It means that Russia and Iran and Venezuela and anybody else is then completely exempt from US sanctions because you're not using the US dollar to trade oil. So apart from providing potentially quite a lot of demand for gold, it signals the end of the petrodollar. It's the beginning of the end of the petrodollar. And this has very, very bearish implications for the dollar, because one of the things that strengthened the dollar for the last, ever since Henry Kissinger brought it in 1970, when they depegged the dollar from gold and replaced it with a petrodollar, was the whole world had to buy dollars in order to buy oil. And that's now coming to an end. The Chinese are turning to the Saudi Arabians and saying, if you want us to buy your oil, it's going to be in renminbi, it's not going to be in dollars. So the role of the petrodollar is coming to an end. US for 50 years, has run a trade deficit and a budget deficit non-stop. So I'm afraid, agreed with most things Nigel Farage said, but we don't share that outlook on the dollar at all. We think the dollar is coming to the end of its, is in for a very troubled time. There's a few other things in America with $70 trillion of unfunded pension liabilities, and Illinois about to go bust, and there's all sorts of things that would tend us to think that the dollar is not going to be the place to be in the long term. And if you're looking at commodities, Nigel was saying, well, the wall in Mexico and whatever is going to provide a big demand for commodities. The massive demand for commodities, all commodities, is going to be the Chinese Silk Road that they're building. This is the biggest infrastructure project the Earth's ever seen, and it's going to provide a massive demand for all commodities going forward. That's one thing. The other thing is that if you look currently at where gold and silver are in their production, the physical market is pretty much in balance. There's a lot of talk about copper going into structural deficit next year. But if you look at the actual physical demand for gold and the physical supply of gold, it's not too much out of kilter. The thing that will make the price move in the short term is investor demand. It's the swing factor. And the thing that will bring investors back to the precious metals sector is inflation. Now, when the Federal Reserve started printing money, quantitative easing, in 2008, there was a surge, worldwide surge, almost unanimous opinion that all this printing money was going to cause inflation, and it caused a flood of investor money into gold and silver. Silver went from $10 an ounce to $50 an ounce on the back of it. Gold went up to $2,000 an ounce. But the universally predicted inflation never materialized. And this is an accepted equation that no economist will disagree with, whether they're Keynesian or monetarists. MV equals P2. M is money supply, which is the amount of money that's being increased in circulation. And V is velocity of circulation. And what's happened in the last 8 years is as fast as M, especially narrow money, has gone up, that's the increase in, that's the print in money since 2008 that the world's that's the Federal Reserve has done in dollars. As fast as M has gone up, V has gone down. So they've cancelled each other out, which is why since the last 8 years, you've not had much inflation and you've not had much growth, because the combination of money supply times velocity of circulation has been roughly equal to the P, which is the price level inflation, and T, which is the output level.
But as interest rates go up, the velocity usually of money does increase.
Exactly. So if you say, well, why is this fall in velocity of circulation is unparalleled. No one's ever seen a fall in velocity of circulation like this. And the closest correlation we can find is the chart on the right, which is the US labour participation rate, which makes actually quite a lot of sense, because there's a lot of talk about the collapse in the velocity of circulation after the 2008 banking crisis, and said all the banks had a shrinkage of capital, so they weren't able to re-lend the money on, which led to a collapse in velocity of circulation. But velocity of circulation actually peaked in 1999 around the dot-com boom. So it was falling for 8 years prior to the 2008 crash, when the banking conditions were completely the opposite. Now, if you look at a chart on the right of labour participation, it pretty much mirrors it. So what you're seeing is that the baby boomers, this is driven by demographics, so the baby boomers after the war, of which I was one, a big, huge spurt in births between 1946 and 1962, is now, 50 years, 60 years later, becoming the retirement boom. And a lot of people in America have, hit 50, hit 55, and they get laid off, and they drop out the labour force. So if you've got the cumulative effect of tens of millions of people going from being workers, earning a salary, to then not earning a salary and not collecting their pension for a bit, it has a tremendous cumulative effect on their ability to spend money. But what's happening now, it's a bit like a python swallowing a rabbit. It gradually, slowly moves through the python, and then it has its own natural ending. And what's happening now is that this process, the retirement of the baby boomers is coming to an end, or the early retirement of the baby boomers, and the labour participation rate is starting to rise. So don't be fooled by, US unemployment's at 4%. How can it be 4% if the labour participation rate's only 60%? The way they count the statistics in America is if you lose your job, after 6 weeks, if you cease to exist, they take you out of the statistics. So there's millions of Americans who don't count as unemployed, who are employed, which is why the participation rate doesn't correlate to the official unemployment rate. If the participation rate now starts to increase, we think the velocity of circulation starts to increase. Now, this is really important for gold investors, because this means that all the money that was printed, all this money, still exists. It hasn't gone away. They've not done reverse quantitative easing. But if the velocity of circulation starts to increase, then either the price level, inflation, has to increase, or the output level. Now, in a mature economy like America, they're already up to 2.5–3% growth. The chances are that if velocity of circulation starts to increase, and it is starting to increase, then you suddenly get the inflation that was predicted to appear 8 years ago will appear, because the printing of money, this money is still in circulation. What's happened is it's been re-lent back to the central banks. So if you're looking for the swing factor in gold demand that's going to bring investors back into the sector, it's the re-emergence or the emergence of inflation that was predicted in 2008 and never appeared because of the reasons we've gone through, but is potentially about to make quite a big comeback.
So if your prediction comes true, you could have an even better performance in your fund for next year.
Oh yeah, because we think, when you look at the way these markets tend to build, the middle phase of the bull market is what we call the bull market proper, when the fundamentals come in. There were no real fundamentals other than it was oversold in 2016. But in 2018, we got the potential oil for gold futures involving huge companies like Russia and Iran, big oil producers, not having to sell their oil in dollars. That's huge. It has huge ramifications for the dollar, and it has huge ramifications because somewhere they're going to need a lot more gold to convert into. So that has ramifications and implications for the oil and gold price and the US dollar. And also, simultaneously, we're seeing this labour participation rate, the bulge in it come to an end. And we expect now to see velocity of circulation, which is crucial to what happens to inflation, start to go back up. So it's not just one thing, it's two or three things coming together that are potentially very bullish for gold and silver.
Well, that's very fascinating. Thank you so much,
Okay.
Ian. And that was a wonderful presentation and philosophy on where the precious metals are going.
Okay.
Thank you.